The Bank of Canada cuts the interest rate again by another 0.25%. There was speculation that the Bank of Canada was going to hold the rate in July, but it's no surprise that they decided to cut the interest rate instead by another 25 basis points, similar to what happened in June. We know that after getting the first rate drop in 4 years, what this basically tells us is that the Bank of Canada is planning a series of rate reductions, which we could see this year. We've already had 2 rate cuts in June and July, and there's room for 3 more, which could take place in September, October, and December this year. In fact, they've already even gone ahead and hinted that a September rate drop is likely coming. If the key interest rate drops a 0.25% each time during the 3 remaining rate decisions this year, then we could actually see the key interest rate at 3.75% before 2025. The last time we saw the rate at 3.75% was a year and a half ago in December 2022. The average mortgage rate in Canada at that time was 6.49% for a 5-year fixed rate mortgage. The Canadian average right now is 6.79%, so only a 0.3% difference, and right now there's a likelihood of a trend of falling mortgage rates as we progress throughout the year. With the core measures of inflation below 3% right now, it's no surprise that we're seeing another rate cut in July and possibly more to come. There's a floating target to reach a key interest rate of 2.75% within the next 12 to 18 months. That would bring us to the beginning of 2025. A key interest rate of 2.75% would need further rate cuts totaling 1.75% that need to take place. This is really good news for anyone who is looking to lock in with a fixed rate mortgage. Right now, the big 5 banks are all advertising fixed rate mortgages at less than 5%, and obviously vary depending where in Canada that you are. There's an exception with Scotiabank, who's advertising the highest fixed rate mortgage at just over 5%. If the banks are willing to lock in borrowers for 5 years at these rates, which have been trending down, then I think we can safely assume that they're all forecasting their mortgage rates to come down over the next couple of years. But how exactly does this impact the overall real estate market right now? The truth is that we're already in a buyer's market, but it's not the buyer's market that you're thinking of. Typically, a buyer's market needs 2 core components. Supply needs to be high, and buyers need to be actively looking to make offers to get the best deals. But the key here is that they have to be actively looking. Right now, they're not. Buyers are actually sitting on the sidelines. They're likely waiting for prices to drop and for mortgage rates to drop as well. Lower mortgage rates means greater affordability and easier mortgage stress tests. There are several key factors that determine whether we're in a buyer's market or not. Let's look at the first one. First is the level of supply. In April 2022, before the first of many rate increases that we saw in Canada, there were 13,000 active listings and 8,000 sales transactions. If you take the ratio between sales and supply, that's how you determine the market that we're in. The 8,000 sales divided by the 13,000 active listings gives a ratio of 62%. A ratio that's 60% or higher suggests a seller's market, which is accurate for the market that we were in during April 2022. The market was hot and prompted several increases in the key interest rate by the Bank of Canada. Today we have 6,000 recorded sales transactions with a total of 24,000 active listings. This gives us a ratio of 26%. Any number below 40% suggests a buyer's market. A ratio as low as 26% suggests a strong buyer's market. That's the market we're in today. So if you're ever trying to figure out what market we're in, all you do is take the sales and supply numbers and divide them. Less than 40% is a buyer's market. More than 60% is a seller's market. Between the two is a balanced market. The 24,000 active listings alone is a way to suggest that we're in a buyer's market. But like I said, we're not in a typical buyer's market. Property listings are not going as quickly as one would think, given that there's usually way more buyers in any market. The difference right now is that in this current market, buyers are not rushing to make offers, and maybe not even rushing to get pre-approved for a mortgage. Even though that now we've had 2 rate cuts, the overall sentiment is that it's not enough to encourage the majority of buyers to get back into the market. This means that sellers will continue to struggle with their listings, sitting on the market at an average of 3 weeks before they can actually sell. Whenever we see low demand like this, is what keeps us in a buyer's market. Falling home prices is another indicator of a buyer's market. We're so used to seeing GTA home prices climb month after month, but lately that has not been the case. In just 1 month, the average price fell from 1.17 million to 1.16 million. Last year, around this time, the average price was 1.18 million. And in 2022, before the rate increases when it was still a seller's market, the average price was $1.3 million. Prices have continued to drop, and this is an indication that it is not a strong market for home sellers. It is instead an opportunity for home buyers. Today's average average of 1.16 million is a 10% drop compared to the seller's market in 2022. Yet these lower prices are still not enough to get more buyers into the market right now. And this is why we aren't in a typical buyer's market. The cost of borrowing for an average price of 1.16 million is still too high for the average buyer in the city, and more rate cuts would be needed to get more buyers into the market. If we see the rate come down in September, October, and December, then we might actually see ourselves head into a true buyer's market. We would see more potential purchasers re-entering the market as soon as mortgage rates go down to a comfortable level. We just don't know what that comfortable level is yet. There's a market statistic that buyers often use to tell whether or not a potential deal can be had for a specific property. The days on market tells a buyer how long a property has been sitting on the market. Today, the days on market is about 3 weeks, with many sitting on the market for a month or even longer. This means that it takes about 4 weeks to sell a property. By comparison, during a seller's market, it would only take 11 days for a property to sell. If a home listing would normally sell within just 2 weeks, but now it's been on the market for a month, then there's probably an opportunity to negotiate the price down. And when you consider this idea with the fact that home prices have been falling, then it should encourage buyers to react and make an offer at a price below market value. But today, we are not seeing much of this. Instead, most buyers have continued to stay on the sidelines and wait possibly for further rate drops or to see where home prices go. The July rate cut of another 25 basis points shouldn't surprise anyone. We've seen so much progress with inflation, and the Bank of Canada considers this when they're making their decisions. If inflation stays high or it climbs too quickly, it triggers a rate hike, similar to what we saw over the last few years. But if inflation trends down, then it gives the central bank a reason to lower the key interest rate. This is what has been happening since June and also now July, but the only reason why the central bank might hold the rate throughout the rest of this year after 2 rate cuts have already happened is if inflation begins to get out of control. Yet inflation picked up from 2.5% to 2.9% between May and June, and the first rate cut still took place. So maybe as long as inflation remains under 3%, the central bank will be satisfied enough to continue with further rate cuts. They just need to be cautious and equally concerned about being below the target as they are about being above the target. Here's an interesting fact. Over the last 30 years, whenever the Bank of Canada cut the rate for the first time during a new cycle, they always followed up with another rate cut at the next interest rate decision meeting. The only exception was in 2015. So if this is a trend that the bank follows, which proves to be right again this time around, then it's possible we'll see further rate cuts this year and into 2025. I think this is a market of opportunity for those who have been looking to get in for a while now. There's speculation that home prices could fall further, and almost a guarantee that mortgage rates will come down as we progress throughout the rest of this year and into 2025. But speculation doesn't always work out in one's favor. So my advice is that if you have everything in place to get into the market, then go for it. Timing the market to wait for further price drops is just as much of a risk as waiting. If you're curious about what's happening in the market and you gain value from this video, hit subscribe to stay updated. New videos are coming out all the time to update you on the market and to give you the best real estate tips. Thanks for watching, and I'll see you in the next video.